doctor?
Still alive.
No.
As far back as I could remember, I always wanted to be a CFO. To me, being a CFO was better than being the President of the United States. I mean, they were not like everybody else. They did whatever they wanted. Andrew Fastow. Andy run the finances for Kinney, who was the boss over everybody at Enron in the late 90s. These guys would hide accumulated losses and debts off the books while aggressively record revenues to boost the stock price. Dollar here, dollar there was all fantasy. Then the bosses would dump the stock while telling everybody else to buy. It was a very good system. All due respect, that's what the feds and the guys at the SEC could never understand.
And now it's all over.
Enron is a company that deals with everyone with absolute integrity.
Enron got pinched and the stock price collapsed. Same thing happened over at WorldCom, Wirecard, and Waste Management.
I'm in a waste management business.
So what, no f***ing ZD now? Hey!
Since getting caught with accounting shenanigans can have a drastic impact on your stock price, what if there was a way to avoid these firms? By looking at a company's financial statements, is there any red flags that investors can use to spot these sussy bakas?
Hello, welcome in. What's your name?
Okay.
One way is to use a so-called M-Score, and we're going to walk through the model and see how it works in practice, and also how you can use it on your own.
People like us, we don't get got. We go get.
The Beneish M-Score is a mathematical formula that takes 8 financial metrics and spits out a manipulation score. The higher the score, the higher estimated probability of earnings manipulation. And these 8 inputs are obtainable from any company's financial statements, so it's quite easy to use. And I will go through these inputs more in detail later, not to bore everyone with accounting just yet.
Kind of makes me look like a bitch. I like it.
Basically, it paints a picture of a company that is growing very fast while fundamentals are deteriorating, combined with some aggressive accounting choices.
I have to go make a call.
In a paper called Detection of Earnings Manipulation, Beneish looked at historical cases of firms that were caught cooking the books. Then he fitted a mathematical model by looking at which factors stood out for these firms. The bigger each of these weights are, the more influence each of these factors have on the estimated probability of the firm being an earnings manipulator. So the model identified 13% of out-of-sample firms as potential manipulators, and half of all actual manipulators were found in this group. Even though this model was estimated way back in the 80s, the M-Score's ability to identify earnings manipulation has been quite good. So in an updated paper, of the most egregious cases of fraud between 1998 and 2002, before it was known to the public, 71% of actual fraud cases were predicted by this model because of its high M-score. Now you might ask, what is actually too high of a number? So here there's a trade-off. If you put the threshold of getting flagged as an earnings manipulator too high, you might be too kind, and you run the risk of missing many manipulators that passes below the high threshold. On the other hand, a too low of a threshold runs the risk of flagging too many innocent firms as manipulators while in fact they're not. Setting the threshold is a trade-off between these two possible errors, classifying a manipulator as safe or falsely flagging an innocent firm as a manipulator. So it all depends on how costly these two errors are relative to each other. So for investors, the cost of a type 2 error is not that high. Say you have a stock in your portfolio and you have looked at the M-score and you think it's too high, you can replace it with something else. There's a lot of substitutes out there. Now, the cost of a type 1 error, classifying a firm as safe while it is manipulating its numbers, can be very costly. Now, Beneish argues that the relative cost could be 20 to 1 or 30 to 1, and that will mean that the cutoff value is minus 1.78 based on the historical data. So using this cutoff level in a backtest, stocks that were not deemed to be probable manipulators outperformed the flagged firms by 10% annually on average. Now here, almost 18% of firms were flagged as possible manipulators, and the actual rate of found fraud is a lot lower than that. But the mere fact that they looked like manipulators was associated with lower forward returns. Another drawback is that this model was estimated quite a long time ago, and since then there's probably been more sophisticated methods of massaging the numbers. That means that the M-score might not be as relevant as it used to be, something that the author is also acknowledging. And there's nothing magical about having these exact coefficients. I bet if you were to estimate the model model today, the coefficients will change, but probably not by much, meaning that the cutoff that we discussed before might be quite flexible. The M-score can also vary a lot from year to year, and a case in point is again Enron. Enron's M-score varies a lot through the years, and not just across time, but also between different calculations. So I found papers that have calculated the M-score for Enron now in retrospect, and I see a lot of differences between the different calculations. But the M-score seems to have been flashing red in 2000s, and in some cases also in 1998. Now, all of these drawbacks are countered by the fact that the model seems to hold up pretty nicely. However, you're not going to be able to spot every case of fraud. There's no such model. However, I think if you're doing screening for stocks, it can make sense to include the M-score as a filter. I, for one, will try to include it in my own process when I can. So you can find M-scores on the web. Some services has it beyond the paywall. There's a website called GoodwillFellas, and they have the number for free. As an example, here's the number for Meta. It's not indicative of manipulation, so let's look at something more interesting. Trump Media and Technology Group, DJT.
Whoa! What?
So this one for DJT is crazy high, way above the threshold. Now, I will argue that this number is a bit misleading. So let's calculate the score for DJT on our own. Now, of course, this is not an analysis of DJT. It's simply an example of calculating the M-score to see all the inputs in more detail, which is useful. I didn't really want to finish the video without any actual examples. So it's not answering a question whether or not you should buy this stock. So to run the calculations, we will use a little thing called accounting. This is the formula for the M-score. These 8 inputs are themselves financial ratios and metrics that uses data from accounting statements. Data that we need to look up in order to calculate the M-score from scratch. Luckily, we don't need pen and paper for this, since there's an excellent tool on the University of Indiana's website where we can input the data. Here are all the inputs you need and where you can find them. You can find all the data you need in DJT's latest earnings report. I looked up the relevant accounting data for each of these 8 metrics using the income statement, balance sheet, and cash flow statements for DJT. And for the folks at home, here are all the numbers I used. Here are the numbers I get for all the 8 financial metrics that are used as inputs for the M-score. And here are the numbers from GuruFocus. And we can see some differences that I will explain. Notice the biggest difference comes from the asset quality index. Now, if you follow GuruFocus approach, they will actually include right-of-use assets when calculating net property, plant, and equipment. And that would mean that you are summing up current assets, net property, plant, and equipment, right-of-use assets. That's going to equal total assets. And total assets divided by total assets is 1, and 1 minus 1 is 0. So you take a number and you divide it by 0. This is not defined. This is infinity. The only reason why GuruFocus has a number that is very, very high is because of rounding. So on our side, let's ignore right-of-use assets for now. We can also see that the depreciation index is slightly lower than mine. So quickly about depreciation. Accountants usually like to match revenues with a corresponding expense during a specific period when that revenue is earned. This is called the matching principle. Now, if a company buys a machine and it expects the machine to help generate revenues for the next 5 years, it does not make sense to record a huge expense for this machine this year to later record more revenues for the next 5 years. Instead, you split this expense into smaller parts, spread out over these 5 years. And this expense is called depreciation. The reason for why the depreciation index is different on GuruFocus is that I used a more stricter calculation that only includes depreciation for property, plant, and equipment specifically. You need to dig into the notes of the financial reports, which can be a bit more cumbersome. I admit it might make more sense to use the total depreciation and amortization, since most companies aggregate those into one item. Also, GuruFocus includes the right of use assets in PPE, which can also be justified. I just wanted to follow the original formula as close as possible. Regardless of which method you use, the 2 versions will not impact the results that much. In my case, the depreciation index you see here is not the one I got using the tool. That is because this value is quite high. Now, what Beneish did to handle values that are way above all the other values, that's gonna blow up the formula, he uses something called Winsorizing. For very, very positive and negative numbers, instead of using those numbers, you can take the 1 percentile or 99th percentile instead. That is why I have 2.65 instead of above 4. And that's the same reason for why the SGA index calculated correctly by GuruFocus gets lowered to 2.19. Finally, GuruFocus includes non-operating income when calculating accruals, hence the difference here. So I would argue
argue that this tool shows a more fair M-score and is not at all the number we saw on GoodwillFocus. So again, please don't overinterpret this too much. This was just an example to get into the details of this formula.
You won't see us getting scammed. No way.
I hope you find this video useful. If so, please leave a comment and like and subscribe if you have not already done so.
Okay, that's all the time I've got. I gotta get back to playing Animal Crossing New Leaf on my Nintendo 3DS.